Hey guys, Carl Allen. Wanted to do a really quick video for you and walk you through what are the 5 killer questions that an equity investor really needs to know. What are they thinking about when they're looking at your deal? So some deals need equity, some deals don't. So if you're putting down a closing payment on a deal, typically you'll need a little bit of equity that you can use to leverage some debt financing, whether it's SBA or whether it's traditional bank debt or all those different things. Even family offices provide debt financing now. They always want to see a little bit of equity going into the deal. And the beauty of that is it doesn't have to be your equity, right? You can partner with somebody else that can be your equity partner, and they can buy a percentage of the deal and sit alongside you in the business and in the cap table. So when you're pitching an investor for equity, there are 5 killer things that they think about. Only 5 things, right? What are they? And why do I know what these are? Because I used to be a private equity investor in a large fund, and I'm obviously a private equity investor these days through my private fund with my partners, doing deals with a lot of my protege students. So let's go through the 5 questions real quick. So the first question that is going to be top of mind for them, and this is in order, right? So these are the questions they think about in this order. So the first thing they're going to look at when they see your deal is, what's the big idea? Like, what's the story behind this deal? And if you think about it, investors get pitched, every hour of every day with deals. And a lot of the deals, they're like what I call a Me Too deal, right? It's nothing differentiated about that deal. So they're looking for something that really stands out. So I'll give you 2 examples of 2 roll-ups that I'm doing that I've raised capital for. So the first one is a big health and beauty roll-up for women. We're buying women-owned businesses, online e-com businesses. So owned by women, for women. Women are the customers of these businesses. And then once we've bought enough of these companies, me and my business partner Ross, we're going to get out of the way and we're going to put in a full female C-suite to run this business. And when we take this business onto the NASDAQ through an IPO, me and Ross will be in the Irish pub down the street. It's the female C-suite that'll be ringing the bell on the NASDAQ. So that's a really kind of big idea. We've been sponsored by Venture Miami, the city of Miami, and there's a lot of investment capital these days flooding into female founder, female owned type businesses. So that's a really big idea that's resonating with a lot of equity investors. The other roll-up that I'm part of is a roll-up in the online education space, but then we're also acquiring professional services companies that we can plug into our students that can help accelerate their journey. So I've just bought a real estate coaching company, and then I'm going to buy a title company that can help my real estate investors close their deals faster by having a plug-in solution for the title and the escrow and the paperwork and all those different things. So having big ideas, having stories that are different and are unique are what really attract investors to deals. The second thing is once the investors kind of sold on your big idea, your big story, then it's all about, well, what's the strategy to scale this business profitably? Is it going to be organic growth? Is it going to be bolt-on acquisitions? How are they going to take this business from A to B? Because that's the only way an investor is going to make money. It's not like a bank that's putting debt financing into a deal. They just want their money back over time with interest, and then they likely want security either from you or from the business to make sure that that money is protected. Investors don't think like that. An investor, if they're putting $200,000 into your deal, it's like, can they get $1 million out, right? Can you 5x their money for them over 3, 5, or however many years? So really, investors, all they care about is scale, right? What's the scalability of this business that you're buying, and can you scale profitably? It's really, really important that you spell that out for them. And it's not just explaining what the numbers are. You've got to provide the justification around it. So it's fine saying we're going to grow the business 20% per year, but how are you going to do that, right? What's the marketing strategy? What new customers are you going to find? Are you going to bring new products or services into the mix? Are you going to go and buy another company and then cross-sell? So you've got to have not only the numbers, but the justification of what those numbers mean. And this all comes down to something called the forecast model. So I did a couple of videos for you recently where I walked you through a forecast model, and you can download that model and use it as well on your own deals. But in a forecast model, the first thing you want to do is you want to look at the existing trends in the historical numbers. So let's say this was your deal, 2021, 22, 2023, those were the historical numbers. You're looking for growth. You want to understand what the current growth is. Can that growth be replicated? And then you're looking at your margins. What's the gross margin in this deal? How can I improve that gross margin as I grow and get economies of scale? And then what are my operating expenses as a percentage of sales? And can I reduce those as I grow? And if you look at this business, growth slowed down a little bit, but the margins have got stronger, both at the gross margin level and the EBITDA level as well. And then you can take all that analysis and plug that in to your forecast model. So let's say this was our deal. It's doing 4 million now, making $725,000 of EBITDA, it's 18%. But as we scale, if we can grow at 15% per year, and we compound that right the way through to 2028, at the same time, we can improve our margins at gross levels, say about 0.5% per year through economies of scale. And then we can take 0.5% per year off our overhead, our operating expenses as a percentage of revenue. Then by 2028, we're forecasting we've got a business doing 8 million and change in revenue and 1.9 million and change of EBITDA. So again, really important, you don't just understand these numbers, but the science behind this. Explain how you're going to grow. Explain how you're going to improve the margins. Investors want to know these things. It's really important. Okay, and then when you're looking at the growth, it's looking at all the different ways to grow. So you might organically grow the business. More customers, more leads, new marketing channels, new products, all those different things. You might do a bolt-on acquisition, so you might buy a complementary business, and that's going to instantly add to revenue and margin and market share. Or joint ventures, you might partner with somebody in the marketplace and offer something together. So rationale is really important. Next, question number 3 is the investor's going to say, well, that's great. I love the big idea, love the story, and I'm sold on your strategy of how you're going to grow this thing and make me money. But who's the team, right? Who's the team that's going to execute on this? Who's actually going to get the job done, right? So this is why it's always really important for you to stay in your lane when you're doing deals. Stay in your lane and do deals in areas that you know, you understand, you're passionate about, and that you can add value to. And if you don't have all of those different skills, go and partner with people. Put people onto your board. Put people into your team that have got the chops, have got the skills, have got the experiences, and have got the network to make this happen. Execution, guys, is everything, right? So you've got to convince the investor that you're putting a team together that's going to absolutely knock this out of the park. And then number 4, it's all about the exit strategy. So the investors sold on your big idea. They love the strategy to scale. They believe the numbers. They think you've got a great team that's going to execute. That's all well and good, but the only way an investor is going to get their money back typically is if the business is sold. So they want to know what the exit strategy is. How are you going to return the capital back to that investor, obviously with a large premium that they're expecting? And there's 4 ways that you can exit your investor. Number 1 is a trade sale. So you and the investor as partners, you grow that business, and someone comes in and they buy it, obviously for a lot more money than what you paid for it. So that's an exit with you. You could sell the business to a larger investor. So private equity, they're rolling up businesses across the world in lots of different sectors. So it might not be a trade buyer or a competitor that buys it, it might be a larger PE firm that wants to come in and take it to an even higher level. Number 3 is you can sell to the same larger investor, but you stay. The investor wants you to stay and continue to execute. They're just buying out the investor that came in with you when you did the deal. Or number 4 is if you're generating a lot of cash flow and you've paid down the original debt you've used to buy the business, you can go and raise another bunch of debt and then buy the investor out. So you're swapping equity for debt, which is great because then that means you end up owning all of the business if you're buying the investor out with debt financing. And then the 5th question is, so the investor loves the story. They love the strategy to grow and they believe it. They love the team to execute and they know there's multiple ways that you can exit them out. The final thing is the risk-adjusted return on investment, RAROI. And it's combining what is the return on investment that you're forecasting, you're promising, subject to the risk that's implied in this particular deal. And there's two types of ROI. One is just a cash on cash return. So if an investor puts 200K into your deal and you exit them for $1 million, they make 5 times cash on cash return. But then they're also interested in something called the internal rate of return, the IRR, which is the compounded annual growth rate of their money in your deal. You might have seen that listed as CAGR, C-A-G-R. C-A-G-R, CAGR, and IRR, internal rate of return, mean the same thing. So let's look at it. So let's look at our business model, our forecast predictions. As we said before, 4 million revenue, 725K in EBITDA in 2023. We scale this up, we make this work, $8,045,000 in revenue in 2028, 1.93 million and change of EBITDA. Now, and let's say we decide in 2028 to sell this business at a 6 times multiple, right? We've bought it at a lower multiple, obviously, but as we've scaled it up, we've made the profit bigger, we've made the business more sophisticated, we can now sell that business for a much higher multiple, and at around 1.6, depending on the industry, you can probably sell for a 6 times multiple. So looking at a 3-year average of EBITDA is 1.615 million, 6 times multiple, that gives us a $9.7 million enterprise value. Then let's say there's a bunch of surplus cash and working capital still left in that business that we've not dividended out to us and the investor. We add that to the valuation. So this is a $10.7 million exit for all concerned. So now we can forecast what the returns are, right? So when the valuation was 2.8 million, say, 200K buy-in, the investor bought 19%. That same 19% upon exit, 19% of 10.7 million is $2 million and change. So that's generating a 10.16 cash on cash return for an investor, which is absolutely insane, right? That's a phenomenal return that you're forecasting and you're promising just by that gentle organic growth and those improvements in margins. So 200K goes in, 2,032,000 comes out, 10.16 return on investment. And then what is IRR? So it's the compounded growth in that equity. And there's a very, very simple formula. Excel, Google Sheets, they have it. But let me walk you through it. It's the cash on cash return on investment to the power of 1 divided by the number of years that the money is invested, minus 1, and then it's a percentage. So the cash on cash ROI in this example is 10.16x, 5-year investment period, 2024 through to 2028. So the IRR is 10.16, the power of 1 over 5, which is 0.2, minus 1 gives you 59% compounding growth. And that's crazy, right? Because if that investor has got their money in real estate, they might get 5% a year. If they've got their money in the bank, they might get 0.5% a year. If they've got money in crypto, they might lose it all, depending on what goes on. Obviously, putting it into your deal, they're going to make 59% annual return on their money, which is absolutely incredible, right? Anything north of 25%, that's a pretty solid IRR that you're promising. And then the whole risk portion goes something like this. So what investors do in their mind is they plot in their brain what's the forecasted return on investment linked to the perceived risk of doing the deal. So obviously, if the deal is extremely low risk, there's no risk in that deal, they might just be happy doubling their money, making a 1x return. But if you've got a really high risk investment, they're going to want very high potential returns, or they're not going to do the deal. So if you look at that log curve, right, when deals are inside that log curve, so the ROI is a lot higher than the perceived risk and it's green, they're going to do that deal with you. On the contrary, if you've got a weak investment case and the ROI is not as high as the perceived risk, then it's going to be the other way around. So guys, those are the 5 things that investors think about. Just to summarize, got to have a big idea, got to have a solid growth strategy to scale profitably, got to have a world-class team or a great team that's going to help you execute and get the job done. Number 4, got to have an exit strategy that's believable, and ideally multiple exit strategies to return investor capital. And number 5, you've got to have a solid case of risk-adjusted return on investment. Hope you found that useful. Don't forget to like and subscribe to this video and to this channel so you get all of my amazing content in real time. And I will see you soon on the next video. Until then, bye for now.